Welcome to This Week in Money. I'm Jim Goddard. Today, Morgan Report newsletter publisher David Morgan tells us the U.S. government fiscal crisis has eroded economic confidence. Gann Global Financial President James Flanagan believes commodity prices are predictable due to a unique 60-year cycle. We'll talk to David Morgan right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome to This Week in Money, the source for market opinions. Sitting in for Phil Mackesy, here is Jim Goddard.
My guest is David Morgan, publisher of the Morgan Report, which you can find online at silver-investor.com. Welcome to the show, David.
It's great to be with you, Jim.
Well, the so-called fiscal cliff met at the very last second in the U.S., and I'm wondering, though, that this problem is not going to go away. They just delayed things again. What's that going to do to the precious metals market? Still make it attractive because we don't know what's going to be going on with the U.S. government's fiscal side?
Exactly. I think the simplest way you can break it down is trust or confidence. The whole system is a con game. It's a confidence game, and it's all about trust and believing or having faith in the U.S. dollar or the Japanese yen or whatever the currency de jure is. Obviously, the U.S. dollar is still prima facie the number one currency, still is reserve currency, although China, Japan, Australia, Brazil, many nation states have moved away from it. They haven't circumvented it altogether. It's still very important and truly the most important in international trade. But the confidence is waning more and more and more. That's why nations that I just named and others have moved away from the dollar and done trade agreements direct in their own currencies, again usurping the dollar. That will continue. So what is the most trusted asset? What is the one that you have the most confidence in? And 4,000 or 5,000 years of history have proven without a doubt, there's no argument about this, there's no opinion about this, it's a solid fact, is that gold primarily and silver secondarily have been the asset class that's trusted. And why is that? Because in and of themselves they have value. So there is no trust or confidence. It might be very in value. Someone might value it more than another, or the price can vary. But nonetheless, there's no confidence issue. So that means that the pressure to move into something that you have less and less confidence in to something that you have absolute confidence in will continue. And if we look at the facts, what we see is the Asian countries and India seem to get this idea a little better than most North Americans, certainly not all. Many that listen to this show fully understand that. Many other nation states fully understand it. But the amount of pressure in the gold market and the silver market, the upside, has certainly fallen off in the last couple of years. But the fundamental fact remains, it's a confidence game. The dollar is losing confidence. China just came out recently and said, to de-Americanize the global system somewhat, meaning there should be alternatives to the U.S. dollar as a reserve currency. And that's been in work now for a few years, and it will continue. So, again, we are going to see, the world will see more and more pressure on the upside. And the Chinese and Indians, I think, are really subtly thanking everyone that's behind these markets for the low price that they've been generating in the last couple of years, particularly in the current time frame. And so we're real happy to trade these U.S. digits, these digital dollars, for real gold. Keep sending it over to us. Oh, we'll take some more. Oh, we'll buy more of it. They keep increasing their net purchases, and the rest of the world seems to have a big yawn and not really be paying attention to the fundamental factors that are driving the gold market, regardless of the price.
Well, Chris Marchese, one of your mining analysts, explained to me if China keeps snapping up gold at the current rate, they'll hold all of the physical gold that was produced this year.
Well, that's right. In fact, if you look at what India buys, what China buys, what is going on in other countries, and you add them all up, what you find is that the total mine supply in a given year is bought basically by China. So who else is buying? Well, some of the public in America, some of the public in Canada, some of the public globally. Also, you have other nation states that are buying it. You have Germany asking for its gold back, 20% of the gold back, and the Fed said, oh, no problem, give us 7 years to do it. So certainly there's physical pressure on the market, and that's why I'm so strong about the fact that this paper chase that we've been witnessing for years and years and years can't go on forever. And the more and more physical demand that's put on the market, which again continues unabated and continues to increase, generally speaking, is going to make the day of reckoning appear. When, I can't tell you. I believe it's going to be probably within the next few years. But it could be sooner, and unfortunately I could be incorrect. It could take longer than I expect, but nonetheless it will happen. And again, coming back to the point, I mean, I think it's already happening, to be clear, and the reason I can make that with some authority is that Germany, I mean, if Germany wants 20% of the gold back from the New York Fed, and the New York Fed says, yeah, no problem, give us 7 years, something is really amiss in the gold market. If they had the gold, it was unencumbered, it wasn't swapped, it wasn't leased, sitting in their vault as a segregated account, as it should be, Germany would be getting the gold back. But they're not. So that is a huge thing, but yet, again, the market seems to just take this ho-hum big yawn on this. Certainly I've been, pounding the table about it from the time it was first announced till now. But nonetheless, again, the market's like, oh, no big deal. Under those circumstances, in any other market, you would certainly see price pressure to the upside. I mean, let's take a quick example. If we went into the wheat market and China said, we're buying X, contracts of wheat for, millions of bushels, and the commodities exchange said, oh, no problem, give us 7 years to deliver it to us. I mean, that'd be all over front page news, and no one would stand for it. I mean, people have got to eat. But when it comes to the gold market, it's kind of like missed by the financial mainstream. And or if it's reported at all, it's, on page 27 on the back pages, and there's one paragraph about it. And then it's blown off. But yet this is probably more important than anything else because, money makes the world go round, so to speak. Really, it's energy. Oil is the most important commodity out there, but nonetheless, gold is extremely important, especially in financial settlement, and was the only way to settle international transactions up until August 15th, 1971, when Nixon reneged on the U.S. contract to pay in gold.
Well, the U.S., for the first time, I think, since the 50s, has become the world's #1 oil producer again. Does that take some of the pressure off the country?
I think it does. We've looked at the fracking situation rather hard. We certainly don't pretend to be all things to all people. We're not oil experts. We're energy experts, but have spent a great deal of time. Certainly the facts are what they are. I would not argue those. But the decline curve on this fracking situation is rather startling. It's an exponential curve. I mean, these things only last about 3 years. So it's sort of like a hamster in a cage. It's got to keep running faster and faster and faster to stay in place. Not that this won't take some pressure off. It will, and it has, and will continue. But I don't think it's going to last very long. I don't think it's a panacea that the mainstream press is talking about. And the other thing is EOEI, energy return on energy invested. And it's not very high. The economics of it, what you would do as a business person to go out and do this, it's very costly. So the overall return for the energy that you have to utilize to get the energy out is not very efficient. And these are things that most people don't even think about because the propaganda press says, oh, we're going to be energy independent, we're going to be able to export, our problems are over, we're better than Saudi Arabia, and on and on. Well, on first blush, there's some truth in what they say. But on a real financial analysis where you were going to make a profit or not on that business model, what you will determine and what you can verify for yourself, don't take my word for it, is the big boys are already backing off on this thing. They see the problems. So you got a lot of these little mid-tiers and smaller companies that are sitting there drilling their brains out. Certainly they're producing, but again, the decline curve is extreme, and the cost curve is about $85. So you get below $90 oil, it becomes pretty much uneconomic to do this. So there's a lot of subtleties about this that are not talked about unless you're in the alternative media or you really have your financial act together and you can analyze these things properly. So is it a boon? Mm-hmm. Yeah, but it's a short-lived one.
More with David Morgan next on This Week in Money.
Always consult your investment professional before making any investment decision.
Welcome back. We're speaking with David Morgan, publisher of the Morgan Report. We were just chatting about how U.S. energy apparently for most people is, the problems are solved. We have lots of oil and gas now with fracking and horizontal drilling. But is that really the case?
Right, and so I think I explained that part of it. But the bigger part of the story is, this can take place in other parts of the world. So certainly there is, reserves out there that can be fracked, horizontal drilled, and you can get more energy. So again, it's going to be a boon for a while. It's going to take place in other areas. It's really spearheaded in the U.S., but will continue in other areas of the world. So certainly there will be a bit of a boom, you might say, in it, but it doesn't excuse the economics. And so it's marginal. In other words, it's a high-cost way to get it. It's expensive, and therefore it's not like we're going to see, $10 barrel oil again. You're not. Again, you've got to be around $85 per barrel or higher for this to be economic to even go out and do it. But again, there will be other nation states. So I'm not trying to paint a picture that's inaccurate. We're still studying it. We're still looking into it. But there are some drawbacks, and, you can also put on the environmental hat and ask questions about whether or not there are problems with it. And there are. I think even the most adamant proponents of it will admit in some instances that it's, destroyed some water supplies, put methane into the water pipes and this type of thing.
Well, I've seen the documentaries where farmers turn on the taps in their house and they get natural gas. They can set fire to it.
Right, and this is a fact. Again, I don't argue facts. But the question is, in my mind anyway, is that a 1% of the time, 10% of the time, 20% of the time? That's the real question. I mean, first of all, if it happens at all, it's horrible. I mean, I'm not excusing that at all. But, I mean, if you look at anything in life, there's nothing perfect in the human sphere, and we make mistakes and accidents happen. So is this an accident that's, less than 1% of the time? And if that were the case, then, okay, I mean, let's grow up and be adults and say, that kind of thing can happen. Is it worth the risk? Yeah, I would say if it's under, 1% or 2%, that's probably worth the risk. If this is something that's more of a 10% of the time, then wow. And the other thing is human ingenuity, learning from the mistake. Is there a way to make sure that it doesn't happen in the future? Or is there a way to mitigate it to almost zero? And if those answers are yes, then certainly, then industry will probably press on. If they're just ignoring it, or they have legislation, which I know they do, I've looked at that documentary myself. The legislation is basically in place that says, you know what, if we screw up, you can't sue us. I don't like that. I'm free market. I'm not for a lot of regulation. I think that, in a moral society, you can self-regulate. The problem is, at the end of these great fiat experiments, the destruction of the morality of the society is directly in line with the destruction of the currency itself. In other words, as the currency is destroyed, the moral values of the underlying society go out the window as well. That's easily proven if you study history. You look at the Roman Empire, it's probably one of the best examples. So you get this legislation that says, you know what, we're going to go out and horizontal drill, and if anything screws up in your water supply, the environment, or anything else, we've got all these really tough environmental laws and the Clean Water Act and all that stuff. I'll throw it all out the window. We don't care about that. We need energy. We need to make a profit. And the only way we can guarantee ourselves of making a profit is to ignore the Clean Water Act. Well, what does that tell you? I mean, I think it says volumes that I can't say in this show because all has been said. So these are issues that are complex. I don't want to take sides. I want to be objective. Again, going back, if it's a very minor occurrence, it happens very remotely, and some of these documentaries are making a big deal out of something that is a big deal. Again, I don't want to discount it too much, but what I'm trying to suggest is that if it's a small fraction part of the time, then obviously it's not going to be that detrimental from the bigger picture perspective.
David, let's talk about something more positive. The Silver Summit coming up in Spokane next week.
Right.
Maybe tell us about that and why the 11th annual. The people who are in the silver business tell me they're always excited to go to it. They make contacts that you couldn't anywhere else in the world. Plus, the people who are there understand the industry, the metal and the history behind it and all that. So it's more than just a hunk of metal that you pull out of the ground.
Well, the Silver Summit was started, as you know, 11 years ago, and it's probably the premier event on the planet for all things silver. And certainly there's other things that are talked about. There are other resources. But it is one of the most enjoyable events surrounding silver that I know of. As you said, a lot of history about silver, a lot of history about the silver mining areas, particularly the Silver Valley, which is very near where the event is held. There used to be mining tours every year that you could attend and go into a mine. If you've never been to a deep underground mine or a surface level mine, you can go and attend those. I don't think that's available anymore, but it used to be. And a gamut of speakers from all over the globe, from the most conspiracy-oriented to more establishment views that there's no manipulation in the silver market perspective. And in fact, this year there's going to be a debate between Bill Murphy, one of the founders of GATA, the Gold Antitrust Action Committee, and Jeff Christian on that very topic. So it should be one of the more interesting silver summits we've ever had.
Yeah, plus you have Jeff Berwick there, and controversy has always been his best friend.
Absolutely, and you've got Bix Weir, I think, with Roto-Roota, which is a very interesting perspective on the powers that be. It very much probably covers the gamut, again, from probably the most deepest, darkest secret to the most establishment perspective, as I just said. So it's a really, of course, I'm a silver bull, so it's one of the most interesting events surrounding silver, as I said.
What about the big disconnect we have between the sales of precious metals? There's a huge demand for gold, for example, and yet prices depressed and mining stocks, my goodness. Someone said there's no bargains out there anymore. Take a look at the juniors, looking for investment. They're in a lot of trouble.
A lot of them are. We're at an event that only happens basically once in a lifetime. I mean, the XAU to gold ratio is at about a 3 sigma, which means that this is an event that is extremely rare. So if you're looking for opportunity, that's where it lies. I would just caution people to look outside the junior space, certainly look at the junior space, but look over the entire thing and see, where you get the most value. So I would recommend that you look at, mining companies that are undervalued, that are producers, mining companies that are mid-level producers, and again, speculative situations. But you don't want to look at just the explorers, because that part of the market's pretty much been rinsed out, and some of these companies may not last a lot longer. But the opportunities in the sector are immensely mouth-watering. I mean, these are now... The problem is, it's a bottom, so most people don't want to buy a bottom, unfortunately. They're taught to buy a bottom, but most people don't have the patience or the faith to buy at these levels. And, 2 years from now, when these things are moving up and they're talked about all over the Internet and that type of thing, people will be much more willing to buy them at a higher level than they are right now.
I know, it's the psychology of the market, isn't it?
It is, indeed.
We're sheep. We want to follow everybody else. And, of course, we remember the high-tech bubble bursting and what that did to everybody's investments. David, is there a website people can go to maybe explore some of your philosophy about precious metals?
Yeah, the best website is silverspeculator.com. That's silverspeculator.com. If they go there, it sort of outlines what we do in different levels of our service, different areas. You can get on our free email list that allows you to look at the Morgan Report for 30 days for free.
After the break, James Flanagan on This Week in Money.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
My guest is James Flanagan, president of Gann Global Financial. Welcome to the show, James.
Thank you, Jim.
You're a big believer in what you call the Gann cycle. Maybe perhaps just explain what that is right off the top.
Well, W.D. Gann was a legendary trader in the first half of the 1900s. His career in Wall Street spanned from 1900 to 1956, and he was one of the few early technicians that actually wrote what he had discovered. And one of the key things, he is perhaps the greatest historian ever on Wall Street. And what he found is there was recurring cycles that went back multi-generations, and he carried prices back to England to the 1200s and determined that there were certain cycles, two of which he called the great cycles, the 60 and 90-year cycles, that held sway in the financial markets, whether the stock market or in the commodity market. And so years ago, I put it to the test and acquired what I believe is perhaps the world's largest database at this point, and discovered that indeed the 60-year cycle is invaluable in analysis.
Wow. Because so many people say we're in such unpredictable times right now, looking at past history doesn't really help. How has it helped, and why has it been accurate?
Well, there's really two schools of thought on that, Jim. There's those that intuitively would believe that history repeats because human nature doesn't change. The hopes and fears, euphoria and despondency of investors is something that doesn't change. And of course, we do have technological changes and innovations, those type of things. And so it really falls into two camps, I find. And I think most people intuitively know that the markets are made up of people that have hopes and fears, and so they tend to excesses either to the upside or the downside. The real curious thing about this, and looking at the Gann cycles, is that they do follow specific rhythm. And what he called the master time factor cycles are unlike traditional or conventional cycles. And this is something that the only way that we could research it when we're talking about like the 60-year cycle is to know what was happening in the 1950s, to know what was happening in the 1890s, and see if these cycles repeat. So I'm an advocate that history, it doesn't repeat exactly, but it very much rhymes. And based on the work that we do, we're of the mind that it can be just uncanny how close the parallels can be.
What kind of parallels have you found, and where are we in this 60-year cycle?
Well, that's a very key question, because we are right at a jump-off point, really, an inflection point in the 60-year cycle. And the 60-year cycle has dominated commodity prices, believe it or not, since before World War I. And whether it was the runaway inflation into the 1920 highs, many of your listeners would remember that the huge run-up in the 1970s culminated in 1980, which was 60 years later. And so the cadence of the 60-year cycle has been almost identical over the course of the last 120 years. Now, for example, 1999, we bottomed in overall commodity prices after a 19-year bear market. Well, this is what occurred between 1920 and 1939. So, every move since 1999, the culmination into 2008, the financial crisis in 2008 coincided with a major decline in 1948. Then a second thrust into 2011 against the 1951 high. Then what was a micro bear market between 1951 and October of 1953. And so we topped out within 12 days of the 60-year cycle in overall commodity prices in 2011. And we are showing that commodities can start to rock and roll to the upside as of an October 9th low against the October 9th, 1953 low. So we just crossed the 60-year cycle just days ago with respect to showing upside. And so one of the markets that we have our clients in on the long side, subscribers, is the precious metals just as of the last week. So we're bullish commodities.
Where do you see the biggest improvement?
In terms of
which kind of commodities do you think are going to be hot or good investments?
Boy, that's a good question, Jim. A great candidate in any market is typically the markets that are in the most oversold condition. And so, as your listeners can appreciate, we want to buy low and sell high. And determining what exactly is low is one of the things that history can help us with. So this recent bear market from 2011 into our lows here in June in the silver, for example, price declined 64%. And historically, that's one of the great bear markets in history when you go back to 1858 to present. So by definition, in defining this bear market relative to the bear markets historically, we find that both in terms of the duration of the bear and the overall percentage decline, the market losing almost 2/3 of its value in 2.5 years makes it a great candidate because, as they say, the bigger the bull, the bigger the bear, and the bigger the bear, the bigger the bull. So by what we call in W.D. Gann called the law of action and reaction, the more oversold a market becomes, the greater the potential there is to the upside. Now, also in looking at gold stocks. Now, gold, of course, has been fixed, was fixed until 1968 in England and 1974 in the U.S. And but we used gold stocks as a proxy. So we took homestake mining back from 1879, and we find that the current bear market decline into June in gold stocks was also in the very elite bear markets in history. So when you're looking at looking to buy when there's blood in the street, looking to buy in extreme oversold conditions, the precious metals fit that bill. And so they are logical candidates at this point. And but there are other markets as well. The energy markets are fascinating on the basis of another methodology of Gann, and I can elaborate on that if you'd like.
Sure. And just exactly what that be?
You have this when you're looking at the overall commodity board. You have these these complexes. You have the agricultural complex, the soybean complex. You have the energy complex. You have the precious metals. You have the industrial metals. So each of these are putting their signature on the bear market since 2011. So all of them have declined in line with this 60-year cycle micro bear market. The most oversold being the precious metals. The energy markets are at the other end of the spectrum. They've held up remarkably well. And so in the crude oil and the heating oil, we're really just a stone's throw from the 2011 bull market highs. And the energy markets have been moving sideways. They've never experienced such low volatility in their history. Now, that only goes back to 1977 as far as them trading freely. Before that, prices were fixed and there wasn't volatility in the energy market. So it was the embargo in 1973 that got things really rocking and rolling.
Today's I was going to say, Thursday marks the anniversary of that.
Okay.
So that's, that was a timely thing to bring up.
Okay. And that said, the longer, Jim, we have in terms of price history, the more repetitions we have of the cycles. So I qualify that in saying, okay, the energies are really historically flatlining. The heating oil, crude oil, gasoline have been incredibly narrow. Now, however, they are in very close proximity to the bull market top in 2011. So they are logical candidates to be the first markets to break into new highs. And by virtue of the crude oil being, the 800-pound gorilla on the board, where crude oil is the most consumed commodity on the planet. So in looking at crude oil as a gauge of commodity inflation, if the crude oil pushes over that 2011 high, which is at approximately 114, if it pushes above there, that market should be in a vacuum, and we should see the energy markets move up significantly in tandem with the stock market, I might add.
Are they quaking at OPEC now the U.S. officially has become the world's biggest oil producer again? Something we probably haven't seen since the 50s.
Yeah, it's interesting. There's a real complexity to the overall fundamentals in engaging what the markets are going to do, whether it's economic growth or supply and demand factors. And the one thing that I ascribe to, Jim, is that the market, everything that is known about the markets comes to bear on the price. So really what I look to do as a technician and really looking at the market from a psychology standpoint, and as a historian, is determining the major situations cast shadows in the market. So really what we're looking for is similar DNA in the market to a situation that occurred previously, historically. And then infer from that it's likely the market is going to unfold in similar fashion. So the market is discount, anticipate the future. Everyone that has money that is willing to put up that down, that's going to show up in price before it shows up in the Wall Street Journal.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're chatting with James Flanagan, president of Gann Global Financial, a big believer in the Gann recurring cycles of commodity trading. How did you find out about this, and why did you find it so fascinating?
Well, that's a good question, Jim. I was during my college years, I went to a school here in Southern California, and there was a couple of guys on my floor that were trading commodities. And one of them is now managing one of the largest bond funds on Wall Street. And they were trading commodities, and I just got fascinated, took an investment class, and I stumbled upon W.D. Gann, one of his books, in 1978, and it was at a Howard Ruff conference, A World Turned Upside Down. Jim, I don't know if you go back that far, but
I've been in the radio business since 1975.
Okay.
So,
well, of course, that was during the zenith of the precious metals boom, where silver ran up and hit $50 for the first time, and the world was going to come to an end. Howard Ruff had a nationally syndicated television show. And so, I stumbled by a book vendor at this convention, picked up W.D. Gann's book, How to Make Profits Trading in Commodities. I'd already started to immerse myself in this area, and the book literally gripped me, because what jumped out at me was, oh my gosh, this guy's a historian. This makes sense. And that was in 1978. From that point forward, I became basically a data hound, acquiring as much data as I could, as far back as I could, so I could prove and hold fast, as he said, that which is good. He said, hey, do this. You're going to need to get the data, check it out, and prove whether I'm right or wrong. And so I took him at face value, and the rest is history, so to speak.
Boy, if you started back in the 70s, you didn't have Google and Wikipedia and all those handy little internet devices to do some instant research. You had to really probably hit a lot of libraries.
Boy, that really does go back. That was fortunately we did have the ability to download end-of-day data and so on, and it was kind of at the start of the personal computer. Basically my first was 1982. But the remarkable thing about Gann is that he died in 1956. When he died, and his everything was purchased, there was 3 Mayflower trucks of paper, because he had to hand draw all of his charts. He had 7 assistants, if you can imagine this, updating his charts at the end of each market day, what we do by just pushing a single button. So this was an individual that was very serious and very successful. He was called a master economic forecaster, the guru of Wall Street. He devoted his life to something, and I haven't worked nearly as hard as he has, but I benefited from the fruits of really his pioneer work.
What was the biggest message you got from his research?
Well, as I started to look at his different methodologies, he, as I said, was a historian, but he was also a market psychologist. And, again, market moves are comprised of people and doing things. And one of the things, for example, that he presents is what he calls the law of action and reaction. And what that means, of course, is that, when markets become overbought, by virtue of their overbought condition, you're going to see corrections. You're going to see profit taking and then additional selling before the uptrend is resumed. And so we all know very well that bull markets don't, go up in a straight line. They experience correction. So what we've done is we've cataloged every leg up and leg down in history in every market, and we use a research engine. We've put a software application together so that, I can ask the question, for example, know what a correction looks like in the silver market historically. And so what we know in the silver, for example, we put the lows in June, and as we did in the gold as well. We saw the run up with the Syrian and Egyptian crisis up until August 28th, which was our first leg rally high. That's what we believe. Our forecast is bullish in the metals. Now, then the silver starts to correct. And then you say, well, what does a correction look like? Well, I'll just give you, just one little thing. As you look at silver, and we have prices back to 1858, 70% of all corrections in the silver are complete within 2 months of whatever the preceding high was. So August 28th is the high. 2 months later is October 28th. So 70% of all corrections will have been complete. And so by probability theory, we just know as the silver was dropping here the other day into a low, I think 1 month and 17 days out from the high, it retraced 67% of the preceding leg up, which is exactly the median of what you'd expect in terms of percentage. So it just fit all of the DNA of a correction and the start of what would be a second leg up. And then we came in this morning and gold surging up, $40 an ounce, silver coming up off the lows. And the thing that was so great about this, Jim, I hope we're not running out of time here, but
we have lots of time.
We're out of time?
No, we have lots.
Okay, good. Well, here's something, and I know you'll appreciate this too, Jim, because, here we have, the advance in the precious metals off the June low coinciding with the Egyptian and the Syrian crisis. As soon as those situations dissipated, the market started to decline into the recent lows here, and it would only spike up a little bit as, it appeared that Washington may not get their act together. So as soon as the announcement came the other day that that the Senate had, resolved this, the House was going to play ball with them, well, the stock market ran into new highs basis the NASDAQ, but the precious metals did not go to new lows, and we took that as a very bullish omen that basically all the weak-handed longs had already sold out, and so we recommended long position. Well, actually, on the electronic session last night at 1293 in the gold, and I think we pushed up to as high as about 1320. So basically the fuse is lit, and we should be starting the next leg up in what should be an aggressive bull market from extreme oversold conditions.
Does this cycle take into account things like a very stubborn Republican sector in the House not wanting to, basically have the government run? Could you anticipate this kind of a crisis?
Well, the thing that, at least observationally and from experience, for whatever reason, regardless of the fundamentals, what I've found, Jim, is that the markets still follow the cycles. Now, that's not to say that there isn't, divergence. There aren't times where I'm wrong. Obviously, that's the case. We're dealing with probabilities, not absolutes. But I could easily produce a dissertation which would say that it makes no difference who's in the White House. It makes no difference whether the Senate is controlled by the Democrats or the Republicans. Give you an example. The bond market is a market that persists in trends unlike any other market on the board. So interest rates. And so we experienced the historic bear market in bonds from 1946 to 1981. That bonds were declining, whatever that is, for 34 years. It didn't matter who was in the White House. It didn't matter what the spending habits were, in Congress. When major changes occur, they persist wholly apart from the lawmakers. Now, that's not to say they can't, have impact on the intermediate and certainly the short term. But I would submit that the markets are bigger than governments, and they dominate in the long run. And I could argue that they follow these long-term cycles. Gann said something. He said, God did indeed geometricize, and certainly I can see that the markets repeating the way they are, in my estimation, is beyond anything other than there is order in the universe.
Wow. Well, that goes against quantum physics, doesn't it? Order in the universe.
Well, depending. It's is it entropy things are, and so I understand that, but all I can say is that in my little niche of the world, and having the benefit of all this history, having cataloged it all on computers, and then, having a track record, I've been in the business for over 30 years now. There's, again, I'm wrong sometimes, but there's times where things can be spectacularly right on things that cannot be explained by fundamentals. It's only as technicians And there are, of course, technicians that ascribe to a cycle theory. There's some people that say, hey, that's ridiculous. Let's be rational here. It's fundamental supply and demand. But we know that the mix of the marketplace are very smart people on both sides of the fence. Very smart people that say no cycles and cyclical analysis and have capitalized on that and been profitable. Then there's fundamentalists who say, no, dispensing with that, this needs to be a rational approach, and they make money as well. So there's more than one way to skin a cat. I just happen to be on the other side with the technicians and believing that market psychology and history are the key factors to that at least direct my steps in terms of what the future holds.
Well, you have 40 years experience, using the Gann system. Is there any way for the average person who probably doesn't want to put 40 years worth of work into their next investment decision, any way for them to kind of, take part of this knowledge or get a piece of it?
Well, Jim, that's one of the things that we wanted to do, that I wanted to do, was harness history and the lessons of history, and then present them in what would be easily identifiable ways to, I'll say, the average investor, and then also the speculator. So one of the things, I'd say one of the primary things that subscribers use us for is wanting to know where they are contextually in history, and that can be a very valuable adjunct to what investors or traders are already doing. So it's, we provide a perspective that's not available anywhere else, by virtue of having the history, and yes, going out and, we spent, hundreds of thousands of dollars in acquiring data, finding it very difficult. We photocopied the New York Times. It's now online, but boy, we did a project back in the day, where we went back, I think 100 years just photocopying the New York Times, finding the pages for the data, photocopying them with the microfiche. Oh my gosh, that was a nightmare. So, all that to say, yes, that we've harnessed history as we see it, and it provides a proprietary, what we believe is a proprietary advantage, and it's very few people that would follow in our footsteps, but we do have our publication. Past, Present, Future has been published since 1990. That's our flagship newsletter, and that does provide seeing the forest through the trees and at a vantage point that it's not available anywhere else.
And how would somebody subscribe to that?
We're on the web. It's GannGlobal.com, GannGlobal.com. And also our 800 number is 800-545-9331. And any of your listeners that would desire to be put on our list, our mailing list, all they'd have to do is call and say, give us your email address and your name, and you'll get on our list. And we're right in the middle of a promotion right now. What we do in our promotions, Jim, just briefly, is we provide a lot of content, just like we would subscriber caliber content. So people get to really get to look and see exactly what subscribers are getting, and determine if it's something that fits into what would or be in alignment with their philosophy and what might help them.
Thanks a lot for chatting with us, James.
Thank you so much, Jim.
Thanks to our guests, David Morgan and James Flanagan. And thank you for listening. I'm Jim Goddard for Phil Mackesy. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.